Welcome to another episode of What the Plus F, where we break down the complexity of ESG and meet those who have mastered how to use ESG to unlock value. What we call the Plus F of ESG. I'm your host, Oliver Barnes, and today on this episode, we'll jump into part 2 of our conversation with a leading ESG practitioner and a value member of the ESG+F Advisory Board, Joel Coward. If you missed part 1 of this discussion, I highly recommend that you jump back to episode 2 and catch part 1 and listen to Joel talking about ESG as a business necessity and how it's found in so many elements of business today. On this episode today, as part 2, Joel shares what he believes an ESG practitioner's job will look like in 2050, including an area of RSG, Restoration, Social and Governance, and how times of war, conflict and disaster accelerates collective action, and what good data and a healthy dose of dyslexic thinking can do to solve many of the world's problems. So without further ado, let's dive back into our conversation with Joel Coward.
Yeah, it's coming back to that risk and opportunity, but what you're looking at, and when they say double materiality, it's effectively 2 axes. So you're taking a simplified approach to say, first and foremost, what impact does this attribute, topic, or issue have on our business as an assessment? You then align it to one of those 26 categories, 26 GICs in our view, because it captures it nicely from a data taxonomy and disclosure point of view, so it serves down the future. And then what you do is you run that exercise again, ideally in consultation with, but sometimes budget doesn't allow, so you're doing it on a desktop basis, but you're then saying my stakeholder groups and what's the impact that it has on them. And that gives you the 2 axes. We take it one stage further, where once you get that and you get high to low, ultimately you want your categories put into priority 1, 2, we call it significant, and then watch list. And once you set that, your first question you're asking the board, if there's an ESG committee, the executive leadership team, and all the other people involved, including stakeholders, do you feel this represents where we stand on the business? If you can't land where everybody is on the same page in an agreement, you've already, fractured the room and alienated people you're going to need on the journey to that process. Once you have that, that's such a really sort of empowering, cleansing simplification of those processes, but it's also a snapshot in time. So that's what we were thinking then. I use Optus actually as an example when I talk about this. Data security is one of those GIC categories, and one of those buckets, and that wasn't a material topic. And the breach happens, and surely now you go back to materiality assessment and go, well, it's moved from significant to priority 1 for us. That is where we're going to spend our dollars, because that has the biggest impact on us as an organization right now. So it's a really kind of insightful point to look at. And then the second stage
for that
in terms
prioritization. It helps that prioritization, taking that risk-based priorities that you say, okay, why do I need to, let's say decarbonisation tends to come out as number 1 at the moment. And you go, great, we've done the assessment on it and we understand why we're doing this. So we are resourcing this. We're putting our capacity towards this because we see this as at risk, or our top 5 risks or our immediate risks are these, and resolving those. And it's a little bit more triage, but that's what, and the power, and you're right, materiality assessments are so powerful, but they're often done so poorly because they'll take it internally and they'll say, we think that it should be this. And you go, no, that's just your opinion or your PR, or that's, Peter principle, where it says it's limited by your own inabilities. Whereas, the approach that you folks are taking with it, and especially with the double materiality approach, and across the stakeholders, getting really quality data from those stakeholders really does make a huge difference. And, say that having done, double materiality assessment, within the last sustainability report that I wrote, which was contributed to. And it's what was really amazing on that was to see what had changed from this year to last year to the year before. And one of the big things that came in all of a sudden was things like human rights and modern slavery, because they're new. And that's because when you're talking to different jurisdictions, if you keep it just within Australia, it can be a little narrow. If you're going multi-jurisdiction like you folks do, you're picking up the nuances of, the Europeans will view this very seriously. Why? Because the Germans have just brought in, mandatory human rights and environmental, supply chain due diligence. That's important. Oh, okay, cool. Uyghur labor is now a big driving part of, the US law and, anti-Uyghur labor, forced labor acts, which is, those sort of things are driving that. So what wasn't apparent a year or 2 years or 3 years ago is now apparent. The only challenge with that is making sure that a company doesn't try and change directions too much as if and where that changes, right? So, or adapts. Again, because themes like decarbonisation are going to be a constant. So again, keeping that objective towards that focus. But the materiality assessment really does, and double materiality, your impact on the environment is really important. And that, I think that's going to help drive, again, impact and effectiveness of your programs based on quality data.
It serves a lot of purposes as well. It takes the bias out of the room, because if you are sitting with a room of parties that want to go on the ESG journey but haven't necessarily got the experience, and one person has more experience, they're going to naturally bring what they've learned, and that brings a skew to the process rather than what is most impactful for the business. The second part, and where it serves, is to really justify how many dollars. What should be the dollar spent from here? So if you end up with 4 or 5 material topics in your priority one, it gets a lot easier to sort of start to set budget and work programs around that. If you suddenly end up with half the 26 in there, you go, we've got a really big problem. Or we're either going to need more budget, or we're going to have to be more ruthless about what we cut back on in terms of, or what risk we then absorb back as a business, and are comfortable with that.
It stops you boiling the ocean as well.
So then, the next stage beyond that, with the 26 GICs, and this comes back to who do we get into the room, but there's a real opportunity here to just run a basic, RACI, responsible, accountable, consult, inform matrix over the top of those 26. So often we now find that CFOs really want to have oversight on climate, because naturally it's becoming, and from next year onwards, mandatory climate disclosure in Australia. It's really very much, and a lot of those sort of accounting skill sets, CPA type skill sets, fall into carbon accounting. Your spend analysis forms are really the baseline data that you're going to use to start to evolve what your emissions profile looks like. So it's interesting, you're starting to see that sort of, I guess, the portfolio of ESG gets split out. I think, and the way we would recommend, I think it really doing that, is to try to keep within that systematic structure, because it again serves all the purposes around data, information disclosure, target audiences.
Well, having the right people in the room as well helps with that data acquisition too, because and that's why it's important to realistically, the best people to have in the room are your executives that cover each major area of the business, including operations, and being able to say, we're going to need this data, we're going to need this information. You're part, as employees, you're also part of our stakeholder group, so we're going to need your help for this too, and getting everybody, not reading them the riot act, but saying we all need to be aligned on this. This is part of how we do business now. It's going to have to, and it's increasingly part of our business. Don't worry. Change takes time, and evolution takes time. Keep calm and carry on. But we all need to be on one page with it, because one of the core things is to remember it's not about us. It's not about the company. It's actually about the people we help. It's about other people, actually, and the role of the company to help, preserve the planet, preserve, biodiversity, preserve, human dignity, those sort of things, right? So it's quite actually an exciting space to be, but you do need those core stakeholders in there so everybody understands. But then also, at the same time, it's much more efficient that you can lift the capability up at the same time, but also get everybody in line with the fact that you say, who doesn't understand this? I don't. I'm not quite sure. Great. Okay, we'll do it together. One team, one executive team, one board. we're going to do this together. We're all going to learn. Because again, for concepts like this is, you also got a generational gap in that knowledge. You'll have, people who are, the sort of the, with age and with, in experience, are up the chain right now or in boards, and this is a new concept to them. I had a conversation with a board member recently, and that was, they said, we really didn't pay much attention to ESG until, their granddaughter turned up and said, Grandpa, you work in mining. Mining's bad. It's going to hurt the planet. And he was like really grieved by that, because he was like, actually, we're producing, copper or nickel or, critical minerals that we're going to need to decarbonize. That's not the case. And that totally changed his perspective on ESG. And then he actually came out and said, we got to lift this for the whole board. How do we do this as one? So it's not done in isolation.
No. You touched on something really interesting there, which is also disclosure. So that's an output. So we talked a lot about the internal components to ESG, finding gaps, the business process improvement opportunities that come from that. Then getting value recognition or what you need to do. You get to a point where certain information fulfills disclosure, and ESG does pull companies to some extent into the world of forward-looking statements, which comes back to data and being able to substantiate that and not have ASIC and ASX bouncing all over you and, saying, please explain, and let's start the process from scratch with linking to reputational risk. But a lot of organizations, have just then lent on an annual rather than a continuous disclosure instrument, which has been the sustainability report. We're seeing, and particularly with our clients, obviously climate becoming mandatory disclosure starts to move into your annual report. So some of those ESG material risks, because it's material risks, and the way the regulators are managing this through the Corps Act, it becomes an annual report function. Whereas in the past, maybe a sustainability report had served that. But we're certainly seeing now probably the third evolution of ESG, particularly as now it's a quantifiable science rather than a sort of principle-based touch and feel. But we're certainly seeing organizations saying, look, this sustainability report, it's been the same year on year and it doesn't actually serve any purpose.
The template. Yeah, I love that.
Tick and flick again. Or the other comment, which is, just do people not read reports anymore? Right? And they get really angry about it, because it is quite a stressful 11th hour type exercise on the back of
it's terrible.
Before or after an annual report. But there's a lot more effective ways to go about disclosure. What's your position on sustainability reports, and particularly annual sustainability reports?
Oh, look, it's a once a year exercise, which is sort of similar to, if I got on a plane and the pilot checked the altimeter once in the flight. Geez, you'd really hope you're at 30,000 feet. And the challenge with that is that it's a good start, and that's okay. It's a good foundation. Everybody it's got to start somewhere. The challenge with it is that it's inaccurate, because it's out of date by the time it's even been published. It's constantly looking back versus in real time. And one of the real challenges, and I'll give you a good example, is if you're doing like an ASX release or a market release, for example, or a quarterly report, and you're looking at, doesn't matter what it is, guidance measures or whatever. One of the things that would be fantastic to be able to do, and one of the great challenges has been to say, well, we, as a company, we've made commitments to be carbon neutral by time X. This was our carbon profile or our water profile, or these core indices that speak to that materiality. This is how much we did or how much we used. It went up or it went down, and start disclosing that to the market, because that would help. Imagine that if you're looking at it from an investment point of view, that you can factor that into how you're able to grade companies, and to say, well, look at their emissions, what's it doing over time on a real-time basis or relatively real-time basis, versus once a year a document comes out that's had assurance. And when I say assurance, it's very limited assurance. It's not as in depth as financial assurance yet.
We know what the assurance market from an accounting point of view is looking like at the moment. So it's tend to follow that same format.
Whereas you could say, if you can provide, in a perfect world, I would love to be able to say, where are we today? Chairperson comes down, or CEO comes down, or major investor comes down, and I can say, today we are here on the map. I can show you on the map where we are on our journey today, and all the data you want, versus an annual PR exercise. It's getting better, but the quality of the sustainability reports is really down to the individuals driving that quality. I mean, because you can see that, and we're coming up to investor roadshow season right now, as all the annual reports are coming out now, whether that be financial, which is a different beast, sustainability and modern slavery statements, and they're vague generalities, bland generalities that are still talking about, we may, we shall, or we want to come to, and we're, but there's nothing quantifiable realistically in there. I mean, other than the things you can quantify, but they've taken a long time to get there. So real time, again, I'd like my pilot and my plane to have real-time altimeters. That would be really good, so I know where I am. I'm not going to crash, right? So
that's one of the areas that we've been investing heavily in, Joel, because we recognize that you have to have a need, but your data has to do two things. It has to, you sit on a lot of internal data that may not be ready for disclosure, but you want to know where you stand. What are our gaps? How have we progressed? So when your MD or someone in the executive team says, where are we at today, you can immediately respond to that. Not I'm sorry, but and the second is then the person that has, under that RACI, but effectively the delegated control, can decide strategically, and particularly working with the investor relations team, what to move across the line for disclosure. When you've got to obviously allow continuous disclosure, so you can't go giving that information out unless you've had an opportunity for everybody to see it at the same time. And our conclusion there has been performance data centers. So effectively, these are well-structured CSV files that break the data, disclosures, the reporting indexes down using that taxonomy. Should always be readily available and can be updated at any time through a website and through portals for our clients. And that's a big area. We think there's a lot more value in performance data than sustainability reports. Now, sustainability are obviously
completely.
So good marketing, and they're great from a case study, and I guess putting color behind the data. But all the investors, the banks, the insurance companies are asking for particular data that their own instruments, ratings tools, risk ratings tools are trying to absorb, to make a judgment, to understand whether they want to do business with the company, and really effectively what would be a risk premium or weighting that they're trying to assign.
So imagine if you took that narrative away from an annual sustainability report, right? All of a sudden, and it was just the data, the numbers, right, that were, relatively immutable and well ledgered in a central space. And you took the narrative away, all of a sudden that drives a different sort of outcome or view on things. It takes the PR away and the fluff, and actually gets down to the core of either you're good, you're not good, or you're improving, or whatever that might be. And I think that's an important thing, because it's, if I said, if you again, mining company, if you said how many tons have we produced today, you would have that information like that, right? It would be, you'd have a real time tracker on it, right? Or how much has gone through the mill, or how much has gone through the refinery today, or whatever. You have that data because that's business critical. But so's ESG. How much has gone out the stack today? You then have to go and recalculate that. The other thing is as well, when you do have that limited, if you've got limited teams in limited people, digitize technology, right? It means it means that then you take the stress out of their lives, because you're then sustainability people, if they've got that core ability to draw that data, you've got it there, that performance data, it means that they can focus on then what's important, not just having to then stress out everybody and then have to go to, head of procurement or some person on a random, work site somewhere and be able to get that data. And then, they're on leave at the moment, or they'll be back. They're on off roster at the moment. Oh, they'll be back then. Oh, I don't know where this is, or I'm not quite sure. And if you do get it, it's in 17 different formats, and you go, oh, good grief. Then you have to compile it and consolidate it. It's really stressful, and which is okay if you can manage that stress, but it's very taxing after a while. So it's that ability of digitization of data is a great enabler for attracting and retaining people, making their workplace a happier, more productive and meaningful place, which might not sound very exciting to people, but when you have to do it all the time, it's draining, and you suddenly go, why am I doing this as a sustainability professional? I'm not doing what I'm supposed to be doing. I'm not there to help. I don't feel like I'm having an impact. So take the drudgery out, digitize it, centralize it, get it that way. It's amazing. It'll make such a difference.
We often talk about, once you've done all that work, the other thing about sustainability reports, or if you're looking at rating agencies or data exchanges, they have to go and run a bot. So they typically run a bot over the top of a report to scrape information. And then depending on how large or valuable that data is the investment time of an analyst to be able to do that work, interpret it, and turn it into something that a data exchange like the Bloomberg, S&P, all the way through to ESG book, MSCI, all of these instruments, Sustainalytics, that are powering, ratings. That's traditionally how it's been done, and it's such an inefficient way to get your information into that global network. So you've got to be able to prepare to take, once you've disclosed data, it just makes total sense. You've made all that investment, take it the last mile. So you can reprocess that data in the format that a rating agency will want to receive it and directly feed it to them. And the amount of times we've looked at people complaining about their ratings, and then we've spoken to the company, or they've publicized when the analyst did the work. And it's like they did the work. It was an 18-month window. You got slotted into that slot. Yet you did your sustainability report arrived 60 days after that work was done. Now you've got 18 months before you're going to get updated again.
Yeah.
Because they're not going to reinvest in that process. And so people get really frustrated with rating agencies, but actually the bottleneck or the flaw is in the process that the company's going about actually getting the information they decided to disclose out there and distributing
completely. And that's still a very manual process too. Even just putting that into, you pick your rating agency of choice, whether it be DJSI or MSCI. It's still a very manual process that takes to be able to go and get that, collect that, and collaborate it, and put it together. And it's just a terrible process. Whereas, if you can digitize that and then draw that all in, like you good folks are doing, it makes life a lot easier and more accurate and in more real time. So you can actually make appropriate decisions, but also at the same time, again, ESG, I mean, the challenge with a lot of the rating agencies right now is again, they're very focused on the E side, the quant side, which is very, very, because that's their realm. They're really good at that. So again, how do you move that quant into the unquantified or the qualitative, to start building that out? And because there can be an overdependence in some regards of someone saying, oh, we got a great score on, DJSI or MSCI or Sustainalytics or whatever, or we got an EcoVadis gold standard or something like that.
Yeah.
Which looks great and is instantly that sugar hit that, every company wants to get, but at the same time, when you start to peel it away, you go, what's this really saying? Well, is this really actually measuring impact and effectiveness, or is this just peer-to-peer comparison? Is this saying, actually, everybody's an inch off the bottom right now, and this person's just a little bit higher above everybody else? Which means that you go, it's sort of like, then it's almost like a race to the bottom, that you go, versus that ability to say, look, all of those metrics and matrix and standards are really important. Don't rely on one, bring them all in, pull them together to be able to get a real tangible view, really triangulate what you're looking for, and the dyslexic in me loves that, because dyslexic will always, we think in pictures, we think spatially, we think in 3D in many cases. So what we want is, we don't just want one linear data source. What we want is we want multiple data sources coming from multiple directions, and we want a tactile experience, and we want pictures and shapes and colors and movements and different views to really form that picture of what does the current state look like right now. That's very easy to say, and it's very difficult to do. And that's
but by getting a data center, there's all of those opportunities. So you typically, we say this a lot with the parties that we work with. The person that's responsible inside the organization that we're championing, supporting, they're delegating to us to do a lot of the mundane pieces here to get them through to that point. But what you're doing is you're getting them ready they've got to have 3 levels of conversations. They've got to be able to have a 3-minute discussion, maybe at a board level, cut straight to the chase. What do they need to know? Is it a discussion, or is it a decision that you're asking for? Then you've got to be able to have the half an hour discussion, which probably executive leadership teams are interested in, that this has happened. We saw this with this happened in this region. What does it mean where we're at? What do we look like versus the rest of the market? And then obviously within the reporting units, the business units themselves, someone's going to want to go deep. They're going to want to have the 3-hour discussion and break it apart and bring it back together. But data pulled together, again, with taxonomy in a systemized approach, can service all of those functions. So, one of the things we see now, particularly with mandatory climate disclosure, one of the things is board oversight. So, that's a really interesting concept and area, but board can no longer pretend that they don't know about this. It's just, you've got to be able to do it succinctly in a harmonized way that they can interpret it and effectively, drive what they need to do from a decision-making process.
And that's a good point. Is that, it's no longer in the ESG world credible to go, we didn't know. I mean, you've got issues of strict liability, and, boards and execs, and now down to individual managers are going to be really exposed to civil, criminal, tort actions for their decisions, and sitting there saying, I did not know. Well, when you're on $500,000 and you're a vice president of a major mining company, for example, it's expected, and you should know. So, the good old days of, deniability, or, some sort of tangible culpability, they go, oh, I didn't know. You do know. You do know now. Yeah. So it's that case of saying, again, that's part of...
That's a massive leap that we've seen in the last 18 months. Not only is it measurable and quantifiable now, ESG, but the regulators have really understood the science. Mm-hmm. So the universe does not need any more discovery. Yes, it's going to naturally continue to evolve, but the regulators are getting really good at this, and they can tell a lot.
They're moving fast too.
Moving very quickly on this.
Not only are they smart, what is smart is your litigants, your litigators. They're getting really savvy, really smart, because when you've got people who volunteer their time and their skill set to be able to help social and environmental causes, for example, they will put their time towards, to help support a claim against a company for ESG breach, or, greenwashing, or, forced labor, or something like that. It's we used to rely on investigative journalists to be 1 or 2 people doing it. Now it's not. It's this army of very tech savvy people who can draw data from all sorts of places and challenge what you're saying almost immediately to then build that claim. And then you get people like Client Earth or Liberty Shared out of out of Hong Kong, who will then take that and utilize that as part of their claim. And that claim is, any legal claim against you is going to be time-consuming, expensive. It does impact on your share, whether people invest or divest. That's a great risk. So again, having that good ESG data at an available point where you can also then use that as part of your shield. And a shield is not just an defensive weapon to defend yourself from. It's also an offensive weapon. You can move forward. You can be proactive with it. So you don't have to sit down there and cower in a corner. You can actually say, well, let's use this data to not only defend ourselves, and if someone makes a claim, we can say, well, look, here it is. We disagree, and we can kill this at discovery. But also at the same time, you've got that ability to be able to say, actually, we're going to use this data because we have identified that risk. Let's knock it out before anything happens. Let's solve it before it happens, or prioritize it, or at least recognize it. And part of that disclosure is that ability to say, we've found an issue. Have we solved it yet? No. But this is what we're going to do about it, and we're going to measure it, and we're going to tell you about it as we go. That rectification, that rehabilitation to some degree, or that resolution, when you find an issue, having good data to be able to help drive that performance and impact to close that out and resolve that is also the next phase of that. That's really important. And, to help companies, but also, again, help people, help the planet. And this is one of the major things that we've seen is that in a traditional corporate sense, if like anti-corruption, if there was an anti-corruption event, there was bribery or sanctions or something like that, traditionally cut and run. So run out of the burning building as fast as you possibly can and distance yourself from them. The challenge is when you look at an ESG issue, it's no longer now of saying, oh, look, we're just going to mitigate it, and by cutting the relationship. You can't. You're going to have to resolve it. You're part of the resolution process. And whether you're good at that or successful at that is also going to be, a real liability. And we're seeing this more and more and more and more, where, environmental sustainability standards are removed publicly because the data is now telling, and the data and the performance, when overlapped, is now saying you're not doing as well. FSC, so Forestry Stewardship Council, did that recently with an operator, palm oil operator in Indonesia, where they publicly came out and said we've been working with them for 18 months. The data and all the data we've collected has shown no progress. We've worked with them consistently. This is what we've done about it, because there was human rights and environmental issues, and we're revoking their sustainability standard. And we've done everything that's reasonable to do. And that's a step change and a shift in how we do business. And it's also a shift in how we look at our duties of care and our fiduciary duties as companies, to companies internally, to shareholders, to stakeholders, to regulators. So the power of that data to help track progress, and track, performance and impact is going to be really critical too, and especially when you've breached those standards, those frameworks where you've gone, whoops, actually we have breached that. That's going to be important to get you back on track.
It's an incredible generational opportunity, particularly for companies like based here in Australia, because we live in a reasonably regulated environment. So we're dealing with international clients and complex supply chains, particularly in the mining industry. But always we've got a high cost environment. Typically, it's not cheap here, and I couldn't believe it when I arrived in Australia in 2014 that people actually fly to the mine site, do some work there, then fly back. But we that just wouldn't happen in other jurisdictions in the world. But my point being there is having a conversation just on price is something that hasn't served necessarily Australian companies particularly well. You become pretty, utility rate of return. You ship something, you lose that value of that and your connectivity with it. What a complete shift this is now happening and turning around, where as actually Australia, particularly as a critical minerals jurisdiction, Western Australia can benefit from this. Got a real role to play, to participate, open up trade internationally. And
see, I have an unhealthy bias towards South Australia, mate. So.
And South Australia. But you get my point. So, you would have been walking into those rooms. I think there's companies that are really sort of, particularly those that have been in the mineral sand sector, have really started to unlock that. Find out what markets do we want to participate in. Let's not try and supply everybody. Let's pick the markets that are going to recognize the value for these attributes that we're able to bring to this commodity, and get some share of that value creation piece that happens typically more downstream than upstream. So,
and the key word there is value. It's moving it, and I know that you can hear the economists shake in their boots as they go, no, Keynes and Fisher and, Friedman, no. It's moving the concept of price and cost to value, because value has, along your stakeholders, your 6 major stakeholder groups, is different to each one. Price and cost is very easy to quantify. Again, that's easy, but value is a little bit harder. And the real thing there is, and you've touched on a very good point, and it was a great discussion I had recently with some groups in Southeast Asia and again here in Australia, where they said, yeah, but our regulations say X, or our environment is saying, let's stay, this is what we should be doing, what we shouldn't be doing. The challenge with it is, to your point, is, and you're right, who do you want to sell to? And set that standard if you can. So if you want to sell nickel or copper or vanadium or whatever to Europe, you're going to have to hit that European standard, and that European standard is going to be way higher than Australia's is right now because of the push in there. So it's not just being good enough to say, oh yeah, in Australia we're good. You're going to have to be European good, or whatever that higher standard is, and hit that. And that's and proving that is really, really tough, because when you look at it from an OEM or perspective back down that value chain, when you're or back up that value chain, I should say, to miners, they don't understand mining, for example, and miners don't understand manufacturers, which is really, really funny. They just don't understand each other. So it's helping them align that together, because again, that case of and then that completes the circularity space as well. So it's whatever that higher standard is, hit it, and don't just be caught up by saying, oh well, Australia only says we have to do it this far off the ground. Well, actually, Europeans now want this. Well, that's what you want. That's what you go for. And not every jurisdiction is going to want that, and that's a real key driver. If you watch those wanting to sell into Europe right now, or into the United States, and increasingly Japan, because Japan is following the EU and the Germans very, very closely, and they always have, because since the Meiji era on industrial development and law, they're the ones lifting the ESG standard because the market is demanding it. So I said it earlier, how you buy, operate, and disclose will define how you sell and who invests. But I'll also say that then the mirror to that is how you wish to sell is going to define how you have to operate, disclose, and buy, right? So
absolutely,
pick your markets.
That's going back to that boardroom discussion where I got shot off at the knees about the ESG donating to the WWF. My experience, and that's why I went on this journey with launching ESG+F, but that's the plus F. I can give examples unrelated to myself, but a great example was a AIM-listed company before ESG was widely used, but they New Britain palm oil. You can look up and follow their story, but they ended up in the palm oil industry, which is full of controversies. They were in Papua New Guinea, so not the primo jurisdiction in terms of yield or economics from palm oil supply, but they could produce a more, I guess, environmentally friendly and bring out attributes in their palm oil. And they didn't want to go compete with price with the Indonesians and the Malaysians. So they went and created their own market. And they started off actually as managers of small estates, and then they ended up acquiring those estates. And they got so good at this through creating an ecosystem that allowed others to participate in it, that so long as they could reach their, what we'd say, values and alignment of values, but they created the Sustainable Roundtable for Palm Oil. And that gradually cleaned up the supply chain to a point that then represented 20%. They could not get enough certified palm oil, and they were selling this at a 20% premium above a very commoditized palm oil. It just, it's traded on the spot market, to the point that it forced the largest palm oil company in the world to go and spend $1.7 billion just buying this business. And it was a really interesting journey that went on for 10 years. And they created, literally from a small palm oil management business, a $1.7 billion AIM listed company.
And I think you're right. I mean, we're seeing this now a little bit more in critical minerals, for example, because what you're buying is now you're moving from Australia loves a commodity. We like doing one thing and selling to one group, and we can only do one thing at a time, right? Possibly two. But what's happening is you're moving from a bulk commodity space, iron ore, coal, that sort of stuff, or maybe even bauxite, where you're sitting there going, actually, now we're selling critical minerals. And especially if those critical minerals are, and if, copper, for example, is coming out in cathode form, what you've got is moving from a primary industry to a secondary manufacturing phase, right? So you're value adding and value creating to have a secondary manufacturing. So a mine with a factory on top, basically. And what we're finding in that is that if done right with ESG, you can get that market accessibility and that set that new standard, because you're creating a product, a desirable product, not a commodity. You're producing kettle chips, not just mashed potato, right? Like it's, you're actually, and so as such, you are in that position where you can influence that better, more fast, because you're producing a more premium, bespoke, I suppose, product, which again, the economists will go, no, this is not possible. It is possible. It has been done. And they'll say, no, economies of scale. And you go, yeah, no, it's just about efficiencies at scale is really what you can be looking at. And changing this concept around to pooling resources, right, is a different thing, where you can actually, the French do it, appellation contrôlée, for example, or, regionalized specialized foods, for example. I'll challenge out there. And this actually came out of a very good person, Lockie Hayes, who's PwC, at a session he did on critical minerals the other day, where he said, and it was a great point where he goes, we need to start thinking about better provinces and better regions on this, to start pooling those resources and those, that capital and those, everything, where you actually do set that standard with like-minded people to create a better product that you can say, wow, this comes out of, the basin of, South Australian, the Gawler Basin or whatever like that. And, isn't this great? But it is possible, and it can be done. And I think you will be seeing that more and more and more. But the difference with it will be, and this is what we found when we were doing blockchain traceability, is that what I'll always love about good data fed into blockchain is that what you're doing is you're moving it from proof to profit. You're proving, and I can prove this. I know where it is. I know where it came from. I know what's in it. I can do this. And as such, you can demand that better premium. And if not, you can then, there'll be a time potentially where you'll say, well, we're going to sell, steel or copper or iron ore or whatever that might be at a discount because of its impurities. And those impurities may include carbon, for example, where you say, well, actually, you're carbon intensive, so we're going to sell it at a discount, or there'll be a penalty on it.
If you allow me to go somewhere completely, I guess something that I've often felt for a while. Obviously, my background's land, water, agriculture investment. We've always had long-term, long-dated type mindsets, and then you get to a mining industry, particularly here. Western Australia, West Perth's famous for it. Did we get $5 million? Did we drill some holes? Did we find something? It's immediacy, right? It's casino type immediacy. And that behavior sort of sits in a number of businesses, particularly on the ASX. It's quite hard to regulate that. But we see it in small businesses. We see it in big businesses. I mean, I don't know if this is controversial or not, but I would argue some of the issues that Qantas are now facing is because they shifted into an immediacy. And maybe that's because of COVID, but they went into a survival component. The fascinating thing from a board point of view is how do you balance, because obviously you want performance and your shareholders are there and you got immediacy. Does your immediacy, is it detrimental to your long-term growth? Because ultimately, if you look at real wealth and how real wealth, which is an ultimate driver for investors, is created, it's through this thing called compounding. Warren Buffett, the greatest master of it. It's about consistency, long-term, on reoccurring, rather than sort of massive hits and massive failures and massive hits. And we all have to remind ourselves all the time, because we love, anyone loves to flutter on the casino or a bit of immediacy, but it's not necessarily a healthy thing. And the challenge with boards when they set, particularly around REM, is a lot of REM and the drivers sit around that. They sit around things that you can measure, which is, market cap, share price, performance. And, particularly I've seen companies invent accounting standards that can completely transform some of those attributes. But then how do you balance that out with some, with I guess, consistent, reoccurring, sustainable, I'm not talking about sustainability, just sustainable growth, that compounding effect. And, ESG arguably is one of those instruments that can be brought into the boardroom. That just is, it brings a counter, and it brings a nice balance to those two forces that are playing on in those organizations.
Yeah, no, I agree with you, and I think that's why it's interesting to see the increase in executive and board in remunerations now. The role of ESG coming in as not 20 to 30% of a long-term incentive scheme over 3 years versus short-term incentives. I've never been a great fan of, because I feel that it drives that immediacy that you said. It's a short-term thinking based on what do we need to do right now so I can get my bonus, versus when you're actually embedding that into a long-term structure, 3 years, for example, which is a good period of time. It stops the immediacy and starts to say, how do we have that consistency and that persistency around what we're doing to start creating that change? It also then upskills and produces a culture within that executive team or that company to get across ESG, why it's important to us, because it does impact us. We're going to get the benefits of it if we do the right thing, and we can really measure that. But it also, again, it helps drive that culture change, because again, we're looking at a newer way of evolving business, and anything new requires culture change, because culture creates performance, and that always starts at the top. I don't care who knows it, who says it. So if you've got that execs and those boards in that space where they're saying, yeah, this is going to be long term, because and that's one of the great challenges we see in ESG right now. Everybody wants that dopamine PR, internal political, status hit that they can put it on LinkedIn and say, oh, look what we did today, and, leak out a tear, and I'm doing it for the children and all that, which is good intentions, but the road to hell is paved with good intentions, right? Versus actually saying, we're going to take a long-term view on this, and we're going to be consistent in it. And in that consistency, that's the first step of, again, going back to what I was talking about, ESG fitness. Start with what you got, work with what you got, start where you are. Every little step counts, every calorie, every time you go to the gym. It's about consistency of performance and persistency of performance over the longer term. And you very rapidly will start seeing results. You'll get plateaus, and then you readjust your training program or your ESG program a little bit to then get that better growth. So again, if we turned it into a fitness app, or we turned it into something like that, it's a different mindset and a different approach to how we do it. But you're not going to be net zero in overnight. This is a long game, and the hard part with those long games is there's going to be eddies, peaks and troughs. There's going to be ambiguity, and that's where your purpose comes in as a company. What are we doing this for? Who are we? And actually live that, not just say it, not just say, oh yes, isn't this great that goes on a PowerPoint presentation and a bunch of investors. You're actually living it, and those investors, if you're living your purpose, those investors know it. They can feel it in the room, and they know that, and they trust that too, because it gives you more patient capital if that makes sense. This is something Larry Fink talked about. Patient capital. So when in his 2020 letter to CEOs, he said that better traceability, better transparency, and better ESG is going to provide that patient capital, which means it's okay not to be okay. It's okay when it's as you're trying to move the ball forward. It is difficult. That's okay. Do it versus the hollow hit of PR, which is going to lead to PR to prosecution, right? As we've said. It's a real change in the way we do it.
Earned, isn't it? And it can be blown in a heartbeat.
Yeah, reputation and this is the thing. Reputation is really important, and they all talk about reputational risk, but there's most of it's PR. When you get a good company, you do get them. And I've been lucky enough to work with one of them. And I've spoken a lot about Oz Minerals, but boy, they were really good. Was you had that good reputation. They had that good reputation. They'd built, but that took them a long time. It took them 7 years plus, again, but that came down through a consistency and a persistency and a long-term view that was shaped by the board, the executives, and then greater culture across the business. And again, not saying it was perfect, nowhere's perfect, but boy, it was good. And you could see it and you could feel it and people knew it. And it's, we live in an age now of, fake news and bad, cheap media and, facile slogans and sound bites. I don't know who people are fooling with that. We're sustainable. We're a sustainable company. Hey, show me how.
Yeah.
Prove that to me. Oh, actually, we're not. What you are is on a transition towards sustainability. That's a different story.
When you can quantify and articulate, this is what our value is, or this is what we aspire to get to, you start to align with people, and you start to your own ecosystem starts to align with people that are absolutely on the journey. I think that that talks to
and that also then shapes your partners. Who are you going to partner with? Whether they be customers, whether it be investors, whether it be suppliers, whether it be capital, because people will go, we align with what you're doing, and we'll work together to solve these issues together.
When I talk to ESG to people, naturally you find high conviction environmental or sustainability people love talking to high conviction environmental or sustainability people, but what they do is they actually end up alienating. I would say it's probably about 70% of the room who are just skeptics. It's all great, but let's live in a real world with real problems. And, so it's an easy, you kind of arm them with an easy sort of counter to that, which is we can't. So why should we try? I often also talk about ESG applies to every company, regardless of size and scale. You can be a coal company and be a really good ESG practitioner. You can be in the fossil fuel industry and say, these are our values. This is how we're doing it. And you're effectively aligning those with people that you're working with. Otherwise, you're just going to have lots of messy relationships.
It's and your point on coal is really good because everyone loves to bedevil coal or oil or gas. And the challenge with it is right now it's necessary. And it's necessary until whenever that might be, right? And there's always going to probably be a need for it because we've always used a heat source. So, without going into the semantics of it, it's necessary right now. So if you're going to be a coal producer, you can still do great ESG, comply with great ESG. And that is still going to help you get that market accessibility because when you are selling coal and you're wanting to sell to Japan or you're wanting to sell to Europe or you're wanting that market diversification away, from what has been, traditional, certainly traditional in the last 30 years or so, core markets and start diversifying that to, de-risk your market access. It's the same deal as if you were a critical mineral. If you've got good ESG, you become that natural choice. That they say, look, actually, we're going to have to buy this. But you know what? We know that this, when we can prove that this is the best, it's got a great, it's not just the product, it's where it's coming from and who's producing it, right? So, and that's that's slowly emerging. You can see that out of certainly with German metal producers, and especially, and that's been accelerated, with the war in Ukraine, where the pursuit of coal is, you still, Australian coal is good coal. It's, high calorific and it's good quality. But also when you can overlay it with the ESG thing, then again, you can be in that position to say, actually, we'd like a little bit more of a margin on this, or we're doing better at it, or we become the better natural choice to do business with. It's, again, ESG helps all things. It's not. It is sort of the panacea, right, to help all things. And your point about,
you can't look past the fact that the infrastructure that sits around those assets, the capital that sits there, that capital is going to come and participate in this transition phase. That's going to be capital that's actually going to help us achieve some of those emission reduction objectives as well. So it's really important not to just blanket people with those descriptions.
You look at Norway. You look at Norway, for example. They grew wealthy through oil and gas, and it's still a core to what they do. It's still a major part. But as they developed it, they were smart enough to say, we've been given this gift, but also our traditional herring fishing, which was, sort of underwrote the economy right up until sort of oil, needs to be sustained. We need to keep this. This is part of who we are.
Giles, this is a new podcast, but one of the things that we're doing with this is we want the audience and previous guests to participate in what we ask the guests that we're hosting. Obviously, it's the first one. So what we did, Giles, we asked a few of our clients and colleagues around the office, and I have no idea what sits in these envelopes, and they had no idea who the guest was. So this is a bit of a blank question, but really the process here, and you'll get the opportunity to then craft some questions for whoever comes next into that hot seat that you're in. But effectively, good old A, B, and C. Choose an envelope, and we'll reveal it and see whether see what lies inside.
I'll take C.
C. Oh. Is there any reason for that?
Start of my first letter of my last name.
not your average marks at university.
Oh, mate, no. You don't even have a letter that's on that list that shows my university marks.
You know what they say, C's make degrees. So anyone out there that's studying at the moment, feel a bit of comfort within that. So, okay, so drum roll. Here's the question. So child born in 2023, when that child hits 27, so 2050, I guess that's the date. There's a lot of long-dated targets against 2050 that we're seeing out there. Will there still be a career in ESG? And if so, what do you think that person will be doing in that role?
That's a good one. The answer is yes, but it will change. It will evolve as ESG evolves. That's why, and I think it will evolve into, from sustainability as we think today to self-sustaining. So self-sustainability. And where we've gone through the process, hopefully, of where we've been able to evolve what we're doing to say, here's business. Sustainable business is we're moving it into a position where it can sort of run itself consistently on the long term. Self-sustaining, because we now can map the value chains upstream and downstream. We understand circularity and we've perfected that. Now means that, or in the process of perfecting that, means that urban mining is now a real thing, that we've got that ability to create a self-sustaining business where partnerships are critical, because partners are not just customers anymore, they're partners. They're how we do business, and we become our customer's customer, for example. So I think we've got a long way to go. So, but 27 years, it's a terrifying sight right now when I'm 44 and I look back and I go 27 years ago. Oh, actually, wasn't that long ago. But what's changed in that has been, what's changed has been technology. I mean, technology drives it, but also the accelerators that come with that technology is social change. I mean, at the moment, we've got a business that's dominated by boomers and X's. And in 27 years' time, it'll be, potentially people like myself or yourself, or, those that are, younger than us now, there's Gen Z coming through now where this is normal. This is a normal part of business. And that's that's why I love Gen Z, because Gen Z shows up, right? I don't care what anyone says. I think they're fantastic because they'll call BS and they'll just get on with it. And I really enjoy that. And I think because that generation's also been traumatized, not by war, but by pandemic, they get it, I think. And that's what will be good. But that ESG role will evolve because, again, and we mentioned this earlier, we may have, become net zero. Great. But those social issues still exist. Slavery, exploitation, responsible supply chain. And the governance is still going to be needed because, anti-corruption, for example, which all sits under the S. So the social side is always going to be very constant. I see the E will hopefully evolve into something where we talk about it. It's RSG, restoration, social and governance, where we are able to reforest, restock, repopulate, regenerate, the damage that we've done. That's where I hope it goes. That's where I think it will hopefully go, and I think, we will have that acceleration through probably a major war or two, which also is a great exacerbator and accelerator for technology and technology change, which is good. So yeah, that's what I think it will. Hope So it's it will evolve.
That's a really good insight as well. So the role may be not ESG, but it will be RSG, and that will be the role that
Yeah,
they'll be fulfilling. So I love that concept.
yeah,
I think absolutely. Obviously 27 years of really rich data, you're going to see decision making flow.
oh,
You're
completely.
going to see spending power shift to the younger generation. So yeah, can't wait to see that, and hopefully I'll be around to
Oh
see
man,
that.
I'm looking forward to the fact that you could get it down to the calorific intake or output of an industry or a factory or a product, where you can sit down there and then decide accordingly on that. So it's it's going to be a long struggle, but I mean, it's the same with technology. Look where we were 27 years ago. You look at the mid 90s, when you know people were. I mean, let's be upfront, right? Like, I mean, even the current boards and leaders, executives now, most of them barely. Most of them didn't have the internet or email until really not that long ago, 27 years ago, I suppose.
Mm.
And it's so ain't social change amazing, right? Like, it's 27 years is a long time. It's also a short time too. And I think that's the other thing to remember in this space is that we're playing the long game, but a lot can happen. A lot can happen in a day, a lot can happen in a week, and a lot can happen in a year, and a lot can happen in a decade. It's just keeping that perspective, and that goes back to what we were talking about, that long-term view and the purpose-driven objectives that we're going to have and need to face, and harnessing that power of quality data to make good decisions and set us up for success. It's not going to be easy. There'll be detractors. There always will be detractors. That's okay. I'm not really, let them. Don't really care. They're on the wrong side of history on this one, I think. So it's, I think the older I've got, and I suppose with my career as well, I started a decade later than people my own age now. So I came in with a younger generation because of my early career, doing what I was doing. So you come in with a much younger mindset, more youthful mindset, to some degree, and that verve and energy, which I still think is really important, and which is often lost, and I think it is lost. I think because people get comfortable and complacent. But with youth comes energy, and I think but we can't just rely on that. We've got to do something now, right? Youth needs direction, leadership, capability and direction, right? And that's what we can hopefully do right now if we start it now, if we do it well. we can set them up to finish it off. Because again, this is not about us. Saving the planet and saving people is not just about us individually. It's about us collectively. And it's changing that worldview from it's not about you. It's about people you'll never meet in countries that you'll never see, and orangutans that you'll never get to see or photograph, but hopefully will still be around if we do the right work. So and society in a better, more equitable space. It's never going to be equal, but more equitable. That's hopefully what I see, and I think that's really actually what it will be. It'll, the RSG, RSEG, rehabilitation or regeneration, social, equitable, and governance. So yeah,
I love that. I saw a saying the other day, and I think it sort of summarizes that really well, which is we overestimate what we can achieve in a year, and underestimate what we can achieve in a decade. Which I think that absolutely sort of speaks volume for this phase that we're in, this transition phase.
You can see that in war is always an interesting benchmark for things, right? And I'm not a proponent for it in any sense of the word, but what you see in a state of conflict and disaster, when it really is a conflict and disaster, is how fast things move. It accelerates it. You can see it. And that's why the automobile is going through it's actually not even going through a revolution right now. It actually is going through a revolution. It's going backwards because it's never been a weapon of war. It's never evolved. It's never been a frontline weapon. Unlike an aeroplane, you look at what started in World War One, and you had kites, basically glorified kites with an engine, and it evolved into by the end of the Second World War, 27 years later, you had like jet fighters and all sorts of stuff going on, which is cool. But the car didn't. I mean, there was more electric cars in 1908 than there were, petrol powered. So we've actually gone backwards, or not backwards, but certainly done a revolution backwards to that state. And we saw that in COVID, get a vaccine, 18 months, boom, done. It was a collective action. Why? Because everybody was impacted by it. Everyone was inconvenienced by it. And I think that's probably going to be the great driver. The day that you become inconvenienced in your life by any aspect of ESG collectively, you'll go, right, we've got to do something about this.
Yeah.
But that emergency is not quite there yet, again, because that's the spur for innovation. So I think that hopefully Stanley McChrystal said it, who was the general, very well thought out individual, quite the contrarian as well, now does a lot at Yale in the leadership space and strategic thinking space. And he said, you're always, actually, you can cut that part because I've got the wrong general. I'll start that again. I'll start that again.
Go for it.
Yeah, General Brown in the US Air Force has done this, where he said you need to create a space of not emergency, but that pressure that comes with emergency to keep that evolution going. That doesn't mean being frantic, but it's like keeping everybody on a keeping things sharp, and to have a pre-crisis crisis. So you're already adapted to that crisis before it even hits. So it's that, and I think that until we get something like that, I don't know what will trigger that. We've seen it with volcanoes, for example. That's always a great one. You saw it with Krakatoa, in the 1800s, and where it completely changed the climate, and you had, a year-long winter, which is then reflected in art, for example. But unless we have a significant climatic crisis or a significant social crisis, for example, that impacts people's lives directly, I think we're still going to be a little bit slow on it. But then in saying that, it's gathering pace. Where were we 5 years ago? Go back to 2015, where were we? You wouldn't have this conversation. It would be very difficult to have this conversation. So again, give that 27 years time. We'll get some very smart emerging talent come through in Gen Z who will be great at what they do, and they'll bring a vitality in the next generation after that, and hopefully their kids, and we'll help support that. But we need to lay that foundation now. So yeah, says a man who's got no children.
No, I think that's. I got one final question for you, Joel, and we can lead into it. But and then we're done, and I'll do the intro. But so yeah, you mentioned something that's pretty close to my heart. I'm was diagnosed, I guess, as dyslexic from good old age of around 6.5, 7, and been on that journey where fun? It starts off treated as a disability, but actually I think it's been an enabler. If I look at my career and where it's taken me and so forth. And you mentioned that you're a fellow dyslexic, and I guess we've got this sort of broader neurodiversity going on in society, or finding ways to classify that. But I am coming across a lot of dyslexics in this space. Do you think that's coincidence, or is that something that is happening by design?
We're coming out.
That's I'm with you. There we go.
What I'm liking about with the dyslexic space is, and it actually relates to ESG, because what dyslexia brings people is a problem solver. They're natural problem solvers. That's why NASA hires 60% of its people are dyslexic, right? They are problem solvers. Right. They know how to do it because they think backwards. They think, and that's their superpower. And it is a superpower. And not only does hiring dyslexics and neurodivergent people add, when we look at ESG and we look at the S side, right? We're talking about inclusion and diversity and equity, for example. That's always tended to be in a bit like environment, in E, it's been down one very sort of narrow lens, which is a good start, great start, and it's a fantastic start. But also as well, we've always been focused on one or two major sort of core metrics in that sort of, inclusion, equity, and diversity space. The moment we start to realize that everybody actually adds value and has value, that's really critical. I mean, you look at it within the military, the best military operations at the moment, everybody in there, well, I would say everybody, but I'd say a very large percentage of the best operators out there, the people that we like to watch films about and movies about and miniseries and television series about, because are dyslexics, because they can solve problems and do the extraordinary. Steve Jobs, Churchill, Bill Gates, Lincoln. You look at anyone that's done anything great and created that social change, they've been generally one of two things: dyslexic or had significant lifelong challenges with mental health. And through that pressure and perspective shift, you get better. You have to evolve. It's I don't know. Are you a left-hander as well, or no?
No, I'm right-handed. So
yeah, so I'm a lefty. So it's always that thing when people say, "Tell us a time where you've had to adapt," and you go, "Be a left-hander." Everything. There's 3,000 people a year.
Fork in the proper hand, though. Brought up with a whip, as my mother did for my sister. But yeah.
But I think the benefit of dyslexia is also going to bring a superpower. Everyone talks about AI and how amazing AI is. AI is going to be great in some regards. We won't, and that's a discussion for another one. What AI is a great aggregator. What a dyslexic is a great thinker and problem solver. So you imagine that, aggregating all that AI data with a dyslexic over the top as a problem solver. That's a super powerful combination right there. And they will outthink and outperform. They will provide you foresight, not forecasts. And that's the power. And you can see this right now. And I'll finish on this note that if you go onto LinkedIn, the bastion of all things, right? You can now put as a skill dyslexic thinking. And that's through the work of a group called Made by Dyslexia, based in the UK. And they did a lot of work with groups like EY. They actually produced a report by EY called the Benefits of Dyslexia. It came out in 2019. Fantastic report that basically said, if you're not hiring dyslexics right now, you're missing this entire pool of people. But their barrier to entry has always been, we were making fun about it earlier about, was that your school grades? My school grades were terrible because being a dyslexic, I just couldn't do it because the structure didn't work for me until I found the ways to work that work well for me. So if you've got those very numerically based tests that, certain consultancy groups now have, and they're, what's your GPA and what did you do on this very, very, very specific numerical test? Well, that's great. You can get all the, very numerical people you'd like, and that's fantastic. That's good groupthink, and that's a very slow death for an organization versus celebrating diversity and saying, actually, this test doesn't work. And there was a great champion for that actually at BHP who helped remove those tests because it prevented quality candidates that went, these people are great, but they're not getting through this thing. And so he was a fantastic guy, a guy called Sandeep Singh. He was very good at it. So he's still there. He's very good. That's because he understood what it was like to be different. He understood what it was like to be come from a different background or think differently or do differently. And, that's what made him great and still what makes him great, So, yeah.
Yeah.
You want to solve ESG problems? Good data and dyslexics. Double
there you
Ds.
go. You get those two together, that would solve all the problems. Well, Joel, look, thank you so much for your time today. It's been fascinating. Coming from your early career, the military mindset, then legal background, and then, being in the trenches again, but on the ESG trenches and showing those experiences. So thanks so much for your time. And, certainly look forward to seeing, what you get up to next.
Yeah, it's going to be fun. And I think this is the thing. It's about being persistent and consistent over the long term. I'll have to listen to this at some stage when I forget that. But no, thank you. And it's been great. Be good and do something good for somebody else. And have a great day.
Fantastic. Bye.
See you soon. Bye.
Well, that's a wrap for today's episode. And what a ripper of an episode it was. I'd like to express my gratitude to Joel Coward for his invaluable insights and for joining us on What the Plus F. I particularly enjoyed the glimpse into the future of what is to come and how ESG seamlessly integrates with businesses, customers, and its partners. We hope this episode has provided you with valuable insights and inspired you to think differently about the potential of ESG in your own business and beyond. Before we sign off, I'd like to extend an invitation to all our listeners. If you're eager to delve deeper into the world of ESG, or if you're seeking guidance on unlocking the plus F within your organization, we at ESG+F are here to assist. Please feel free to visit our website, www.esg-f.com, and book a one-on-one session with us today. Additionally, if you have any specific questions, insights, or feedback about our discussions here, please do not hesitate to reach out on Spotify, Google, or Apple Podcasts. We greatly value the perspectives of our audience and contributions. Your contributions could very well influence the content of our future episodes. Thank you for tuning in, and we eagerly anticipate your company in the next episode.